Every year, American households lose hundreds of billions of dollars in real value while their savings sit in the bank. That is the part no one says out loud. Because it sounds impossible, it sounds wrong. It sounds like the kind of thing that should never happen in a stable country. Yet here we are coming in 2026, watching the safest habit in American life turn into a quiet drain under every household. For decades, saving meant security. It meant dignity. It meant you were doing the responsible thing. But the numbers have changed faster than the beliefs that guided a whole generation. Rates that look fine on paper lose to prices that refuse to fall. Deposits that grow in dollars shrink in power. And a system under record debt now leans on negative real returns the way it once leaned on growth. If you feel like you are standing still while everything around you climbs, you are not imagining it. The rules have shifted, and the safest choice may no longer be safe at all. Stay with me because the next few minutes may change how you see every dollar you hold. On nostalgia versus quiet shift. There was a time in this country when putting money in the bank felt like putting weight on solid ground. You saved a portion of each paycheck, closed the passbook, and trusted that the balance would quietly work in your favor. People did not need complicated tools to understand it. Older Americans still remember that rhythm. One retired factory supervisor in Indiana told me, "Son, interest used to pay our winter bills. We didn't scramble, we didn't worry." You saved, and the bank showed you respect for doing the right thing. There was nothing dramatic in the way he said it. It was a calm memory of a world where effort and outcome lined up more neatly, where patience felt rewarded instead of strained. In the early 1980s, that picture made perfect sense. Deposit rates climbed to levels that sound unreal now. Families often covered part of their yearly expenses from interest alone. A certificate of deposit wasn't a gamble, it was a dependable tool. Parents taught their children that saving early would build a safer future, and for a long stretch of American life, that was true. But in 2026, that old lesson no longer lands the same way. The landscape around it has changed. Many households describe the same feeling they save. They plan, they try to stay careful, yet the cushion never seems to grow as it once did. Instead of a sense of progress, they feel like they are holding position while everything else moves. The contrast is hard to miss. A generation ago, saving felt productive. Today, families often say it feels stagnant. They watch their balances rise in dollar terms, but the impact on their lives does not match the number on the screen. They see grocery receipts widening. They see monthly bills creeping up. They see the distance between their efforts and their stability growing a little wider each year. What unsettles people most is not a single event. It is the slow, quiet shift. Saving didn't stop helping overnight. It just helped a little less each season until many households began to sense that something was different. That same supervisor in Indiana summed it up gently. "It didn't fall apart in a day. It just stopped keeping up when we weren't paying attention." There is no anger in his voice, just the recognition that a familiar tool no longer performs the way it once did. And that is the heart of this change. Not a dramatic break, not a crisis headline, just a gradual decline in the ability of a savings account to hold its place against rising costs. People feel the tension before they understand the cause. They sense the drift even if they cannot explain the mechanics. But the mechanics matter. And to understand why saving feels so different today, we have to step out of memory and into the numbers. Because behind every quiet shift is a simple arithmetic that decides whether a dollar grows or shrinks over time. To the math that destroys savings. The numbers move quietly in the background, but they shape everything. And right now, those numbers show something most people never expect: a savings account can rise on paper while losing ground in real life. Look at what's happening in the simplest terms. Many Americans keep their money in accounts that pay about 0.6% a year. Even the better online accounts pay around 4% if you look hard enough. When you check your balance, it climbs. A slow climb, but a climb. It feels like progress. Now place that next to what households face everywhere in the country. Over the past year, prices have risen about 3% overall. Some essentials move even faster. Meat and eggs are more than 5% higher. Housing costs continue to rise 3 to 4% depending on the area. These are not financial headlines, these are grocery bags, rent checks, and weekly routines, so the math becomes very clear. If your money grows at 0.6%, while prices rise around 3%, the value of your savings steps backward by more than 2% each year. Even a 4% account barely outpaces inflation, and after taxes, the gain gets shaved down even further. A dollar grows in appearance, but not in strength. For many people, this doesn't show up as a calculation. It shows up as a feeling. You add money to your account. You see the balance tick upward. But when you go out to buy the same basket of groceries or pay the same monthly bills, the money doesn't stretch like it used to. Try to imagine. This situation is like walking up a stairway that moves the other way. Your steps are real. Your effort is real. But the ground beneath you tugs against your progress. Some people climb fast enough to stay level, but almost no one climbs fast enough to rise. And this isn't a matter of discipline or planning. It's the result of how the system treats ordinary savings. The bank adds a little interest to your account. Inflation quietly takes a little more out of your purchasing power. Taxes trim the rest. None of these pieces are dramatic on their own, but together they pull families in the same direction, a slow drift they can feel long before they can explain it. This quiet erosion is what makes saving feel different now. The math used to lift savers. It now presses down on them. By the time households began to feel the difference, the gap had already widened. And this leads to a question many people never think to ask. If savings lose value, even while balances grow, what force keeps that pattern in place? Why do returns stay below rising costs year after year? 3. The silent tax. Let me try to explain it the way you would explain something to a neighbor at the kitchen table. When you save, you expect your money to grow a little. Maybe not fast, but forward. Yet, year after year, people see their savings rise in dollars while everything around them grows more expensive. It feels as if something is out of sync. And in a way, it is. There is an old idea in economics simple to understand even if the name sounds technical. It's the idea that a country can ease the weight of its debt by keeping the return on savings lower than the pace of rising prices. When that happens, the real value of what the government owes becomes lighter. It's not a trick. It's not a plot. It's more like a long-standing method that has appeared many times in history when debt grows faster than the ability to pay it down. You can see this most clearly in the period after the Second World War. The United States, like many nations, carried heavy public debt. Instead of raising taxes sharply or cutting everything at once, leaders allowed interest rates on savings to sit below the rate of inflation. The result was that, over several decades, the real burden of the debt fell. The dollars the government repaid were easier to carry because their value had slipped a little each year. Savers did not feel the change all at once. It was spread over time, almost like a slow adjustment built into the landscape. That same pattern appears again today, though the setting is different. The national debt is larger than anything seen in earlier generations, and the pressure of servicing that debt is rising. In an environment like this, keeping real returns low becomes a way to manage the load. It doesn't call attention to itself. It doesn't announce its presence. It sits beneath the surface, quietly shaping the experience of every household that holds money in simple savings accounts. Here's what that means for you and me. When the interest you earn sits below the rate at which prices climb, a small piece of your buying power is trimmed each year. You don't see a deduction. You don't see a penalty. You only notice that the money you set aside for later buys a little less when later arrives. For people who save out of discipline or caution, this can feel confusing. They did what they were taught. They set money aside. They expected time to help. But the environment around saving changed. Quietly, gradually, almost without anyone saying it out loud. This is where the idea of a silent tax comes from. It is not a tax in the usual sense. No one charges it, no one collects it. But the effect is similar. A small share of value drifts away, and that drift helps ease the financial pressure somewhere else in the system. Not because anyone wishes harm on savers, but because the broader structure leans in that direction during periods of heavy national debt. And this is why so many families feel like they're giving more effort yet holding less progress. But this pattern raises another question. If this quiet erosion supports the system, when does the pressure peak? And what happens when the calendar turns to a year where the debt itself forces a sharper adjustment? To answer that, we need to look at why 2026 sits at the center of this shift. 4Y 2026 is the pressure year. In late 2025, the national debt meter crossed another line. It moved past $38 trillion with no sign of slowing. And for the first time, many Americans began to hear a new phrase from economists on evening radio. Interest costs are now one of the largest expenses in the federal budget. Most people shrugged at first. Debt has been rising for years. But the part that matters in 2026 is not the number itself, it's the timing. Here's why the calendar suddenly matters. When the government borrows money, it doesn't borrow it forever. Much of it comes with an expiration date, meaning it must be paid back or refinanced at current rates. And in 2026, a large wave of those older, cheaper bonds comes due. The government must replace them, but at today's higher interest costs. A senior analyst at the Committee for a Responsible Federal Budget explained it plainly in an interview last year. The issue isn't just how much we owe, it's how fast the interest bill grows when older debt rolls into newer, more expensive debt. That line captures the entire point of this arc. The pressure isn't abstract, it is built into the schedule. To understand this in simple terms, imagine a household that took out a low-rate mortgage years ago. When the fixed term ends, they have to renew it at the rates available today. If today's rates are higher, their monthly payment jumps. That pressure isn't caused by mismanagement or overspending in the present, it's baked into the contract. The same mechanism applies at the national level, only with numbers so large that even a small change costs billions. And we are already seeing the consequence. In fiscal year 2025, the United States paid roughly $970 billion in interest, more than it spent on national defense. The Congressional Budget Office projects that interest costs will cross $1 trillion a year as we move deeper into 2026. That is money that does not build roads, support veterans, or improve schools. It is simply the cost of past borrowing. As obligations stack, policymakers face a quiet but firm reality: the federal budget cannot absorb sharply higher interest costs year after year. And that is where the link to everyday savers becomes clear. If interest rates stayed high, in real terms meaning higher than inflation, the government's burden would become even heavier. So the system leans toward keeping real returns modest. Not because someone is plotting against savers, but because the overall structure bends in the direction of survival. This is why 2026 feels like a hinge year. The rollover of older Treasury debt forces the government to confront today's realities, not yesterday's bargains. The interest bill rises whether anyone debates it or not. And when a system adjusts under that kind of weight, the pressure never stays in one place. It moves outward, it reaches banks, it reaches markets, and eventually it reaches the saver who wonders why their returns never rise as fast as their bills. Nothing about this shift happens overnight. But 2026 is the moment when delay becomes harder to maintain. The rollover schedule does not negotiate, it arrives. And it brings the true cost of borrowing into full view. Which brings us to the next part of this investigation: how all of this lands on ordinary households, and why so many families feel squeezed even when they're doing everything right. 5. The household trap. When the country's debt costs rise, the strain doesn't stay in Washington. It settles quietly into everyday life. You see it long before anyone explains it. Prices move ahead, paychecks stay familiar, and the small cushion families try to build loses strength faster than it gains shape. That's the shift unfolding in 2026. Groceries are up, housing is up, utilities are up. Even basic repairs cost more than they did only a year ago. None of these changes feel dramatic on their own, but stacked together, they narrow the room a family has to breathe. The savings they try to set aside each month simply can't keep pace. A little interest comes in, but rising bills take more out. Across the country, families describe the same quiet pressure. They save out of habit. They save out of caution. But the progress they expect doesn't show up anymore. In Ohio, Lisa and Mark have been saving for years. Nothing bold, just a steady habit built back when saving felt like a reliable way to stay prepared. Recently, they told me they've started to dread their end-of-week budget check. Every section is bigger than it used to be, Lisa said. Food, gas, school things. It all slides a bit higher and our savings don't stretch with it. Last year alone, food at home rose more than 5%. Their grocery cart looks the same, but the receipt doesn't. Rent went up again. The electric bill climbed enough to notice. A doctor visit left them with a copay they hadn't planned for. They're not careless, they're overwhelmed by how often the ground shifts. A similar story came from Phoenix. Arturo works long hours at a warehouse and cleans office buildings on weekends. He used to save for emergencies. Now he saves for the last week of the month. I'm not aiming for anything big, he told me. I'm just trying to make sure we don't come up short. He shook his head while saying it not in anger, but in a kind of tired disbelief that life can feel this tight, even when you're doing all the right things. These stories aren't rare. Surveys show more than 60% of Americans live paycheck to paycheck. Many earn solid incomes, but the basics rise faster than their wages. Credit cards fill the gaps and balances grow heavier. Auto loans stretch over longer terms. Even families with steady jobs feel like their footing is less secure than it used to be. The hardest part is what this pressure does to people's sense of progress. Saving used to feel meaningful, like building a little shield around the future. Now it feels more like trying to keep from sliding backward. Households make plans, but a single price jump can erase a month of effort. A single unexpected bill can send them scrambling. And as they look around, they notice something else: not everyone is stuck. Some neighbors move forward with ease. They buy homes, invest, travel upgrade. They live in the same economy, face the same prices, and yet seem untouched by the squeeze. That contrast creates a kind of quiet confusion. How can the same conditions hold one family in place and lift another? Families don't have the time to study the mechanics behind it. They only see the result: one group stalls while another rises. One struggles to hold steady while another appears to be carried upward by a different set of rules. And that brings us to the next question, one that sits beneath every story you've heard here. What divides the households who stay trapped from the ones who keep advancing, even when everyone lives under the same sky? 6-2-speed America. Some households stay stuck while others rise. Same prices, same economy, same headlines, yet completely different outcomes. That contrast has become the quiet dividing line of 2026. On one side are families who keep most of their money in cash because it feels safer. It's what they grew up trusting. It's what their parents taught them. Cash doesn't swing. It doesn't surprise anyone. It just sits there. But in an inflationary world, sitting still has a cost. On the other side are households who place a portion of their income into assets, index funds, retirement accounts, even small brokerage portfolios. These assets move with markets. They can rise when the cost of living rises. They can adjust when prices shift. That movement is what gives them the ability to stay ahead. The difference isn't character. It isn't ambition. It's speed. Cash moves slowly. Assets move quickly. And in a year when prices shift faster than paychecks, the gap between slow money and fast money widens. Think of a simple example. A family keeps their savings in a regular bank account, earning barely more than zero. Inflation climbs 3%. Their dollars lose strength even as the balance grows. Another family puts part of their savings into an index fund that grows with the market over time. It's not a guarantee, but historically, market returns tend to outrun inflation across long periods. One household holds still. The other keeps pace. That gap adds up. According to Federal Reserve data, the top 10% of Americans now hold more than 2/3 of all financial assets in the country. These assets, stocks, bonds. Retirement funds grow with economic cycles. They may dip and rise, but over time they follow the broader movement of the economy. Meanwhile, the families relying mostly on cash watch their purchasing power slip because cash has no way to adjust. The lived results show up everywhere. One family sees their savings account get thinner in real terms even though they keep adding to it. The other sees their retirement account expand enough to absorb higher grocery bills or home repairs. One household sticks to the same habits and feels like they're sinking. The other makes the same grocery trip and shrugs because their investments soften the blow. And that's the heart of this split: two groups living in the same economy but traveling at different speeds. One moves with the cycle, one moves against it. And the longer inflation lingers, the wider that space becomes. You can see this divide in the small choices families make. One hesitates to spend because every dollar feels heavy. The other spends more freely because their money has a way to recover. One shapes their budget around limits, the other shapes it around flexibility. This two-speed reality wasn't built overnight, but 2026 has made it unmistakable. Cash, once a symbol of security, is losing ground to a world that rewards movement. And that brings us to the final shift, the new rule of saving in America, and why the old definition no longer fits the world we live in now. 7 new rule of saving. Saving today works best when the timeline is short. That is the part many Americans are discovering through their own bills and plans. Cash still matters. It still protects you, but it protects you in a different way than it once did. Look at what has happened over the past few years. Prices for everyday goods, food, housing, transportation have risen faster than the interest most banks pay. When costs climb 3% in a year and your account grows 1%, the gap shows up the moment you try to use that money. A repair you expected to cost $500 turns into $600. A medical bill you planned for grows by another $50. Savings did not fail. The price moved ahead. That is the key shift. Time now carries a cost. The longer money sits, the more it falls behind the world around it. A household that keeps 2 months of expenses in cash is protected. A household that keeps 5 years of plans in cash ends up watching those plans drift away. This doesn't require complicated math. A dollar saved for next month still works like it used to. It buys groceries, covers a surprise bill, gives you breathing room. A dollar saved for 3 or 4 years loses a slice of its strength each season. You can see it in the cost of school supplies and the rising price of tires, in insurance premiums that adjust every renewal cycle. A couple in Michigan explained it in plain language. They spent 2 years saving for a small home upgrade. "We hit our number," the husband said, but the contractor's estimate was almost 1,000 higher. The goal stayed the same. The price didn't. Their effort was steady. Time was not. This is why saving feels different now. For short-term needs, emergencies, bills, repairs, upcoming expenses, cash remains the surest tool. It responds instantly. It doesn't depend on timing. It keeps you steady when life turns unexpectedly. But when the horizon stretches, cash loses the ability to hold its place. The old idea treated all saving the same. Money for next month and money for 5 years from now lived in the same drawer, followed the same rule, and carried the same expectation. That rule fit a world where prices moved slowly and interest returned enough to protect the waiting. The world has changed. Household costs rise more quickly. Real returns fall more quickly. And the gap between saving for stability and saving for the future grows wider each year. The result is not dramatic, but it is clear the job saving in the near term is stronger than the job it performs in the long term. A teacher in Minnesota described the new reality: "Well, I'm still saving. I just expect it to help me for the next few months, not the next few years." She wasn't frustrated. She had simply adjusted to what the present economy allows. That is the new rule. Save for what's close. Protect the next season of your life. Build the cushion that keeps stress from becoming a crisis. But recognize that time changes what cash can do. The longer it sits, the more it gives up to rising costs. Saving hasn't lost its purpose. Its purpose has narrowed. And understanding that narrower purpose is what gives households clarity instead of confusion, a steady way to plan in a world where money moves differently than it once did. After all, just remember this. The shape of money has changed and every household is feeling it in one way or another. But clarity is a form of strength. When you understand how the system shifts, you're no longer caught off guard by it. You can plan your next steps with steadier hands. You can prepare for the shocks and protect the parts of your life that matter most. This isn't about fear. It's about seeing the landscape as it is and moving through it with awareness instead of guesswork. The rules may be new, but with clear eyes, you can still navigate them.
This video does not promote division within the United States or encourage segregation. All content is presented for the purpose of exploration, analysis, and fostering discussion based on current events, public sentiment, and social trends. We fully respect the United States Constitution and all federal regulations. If today's analysis made you think, drop a comment so we can keep the conversations going. And don't forget to like, subscribe, and hit the bell so you will never miss our next independent deep dive.